Hello, my dear friends. Welcome to Hari Seva IBBI Valuation Tracker. Today we are starting second session of valuation of real estate. In first session, we learned cost, price, and value, and six type of other value, that is fair market value, book value, distress value, forced sell value, and liquidation value. Today we will learn balanced type of value. The value, we are starting from breakup value. Breakup value, the value of a running business or unit is being shut down when it is being dismantled or closed down, and the individual assets are sold separately rather than a whole. If any breakdown units, assets are sold in different individual assets, say machinery sold separately, land sold separately, building sold separately. So that is all the sum of that value is called breakup value. The asset may be sold to different buyers, and total breakup value is the sum of the value of all individual assets. This method does not consider the overall value of the unit as a going concern. It focuses on the value of individual assets. Now, going concern value. The going concern value is the estimated value of a running business in the open market, including all tangible and intangible assets such as goodwill, along with its liability on the date of valuation. It represents the price a buyer would pay for a business that continue to operate and generate income, as opposed to being dismantled and sold for individual assets. It includes assets like land, building, machinery, and goodwill, reflecting the business ongoing profitability. So this going concern value is when any company is a running condition, going concern, doing his business in full speed, say in peak period. If that company is sold and buyer will run the company in same fashion or improve the company productivity, is called a going concern value. Next is statutory value. The value of property that is determined in accordance with specific legal provision or regulation. This type of valuation is mandated by law, and the method or guidelines for calculating the value are strictly defined in the relevant legal frameworks. A classic example is the valuation of property for wealth tax under the Wealth Tax Act, where the value is calculated as per Rule 3, Schedule 3 of the Act. Statutory value does not necessarily reflect the market value or actual selling price of property, because statutory value is calculated as per the legal provisions of the law. So it does not necessarily, it may be tally with the market value or actual selling value. That may be different due to specific values calculated as per the relevant department laws. It serves specific legal, regulatory, and taxation purpose. Annual letting value. In my IBBI exam, this question came one number of MCQ. For definition, they are given, they ask which value is that one. That was the annual letting value. The rental value of property assessed by local authority for the purpose of levying property tax. Say if municipality want to collect the property tax, so first they will calculate the rental value. According to rental value, they will fix the tax, that is called the annual letting value. Replacement value. The estimated cost required to replace an asset with a new one of the similar kind, quality and functionality. If any assets is replaced with a new one and to the present rate, that is called a replacement value. It represents the amount needed to purchase or construct an equivalent asset, either new or modern, at current market price. The value is often used in insurance and property valuation when determining the cost of replaced asset damaged or lost. It reflects the current cost of new asset with similar features, not the original cost. Next is depreciation. We will do study in detail depreciated value in separate chapter, and calculated how to calculate the depreciation by various methods: straight line method, decline method, sinking fund method, written down value method, in separate chapter. Here we are reading only definition. Depreciation is a process of allocating the cost of tangible assets over its useful life. It represents the decline in the value of asset due to factors such as wear and tear, uses, age, and obsolescence. Due to age and wear and tear, property life, property is reduced. That is called the depreciation. It applies to physical assets like building, machinery, vehicle, etc. Depreciation calculated annually using method like straight line, declining balance method, sinking fund method, and written down value method. Depreciated value. Depreciated value is the current value of an asset after accounting for the depreciation. It is the original purchase price minus the total accumulated depreciation. This value reflects how much the asset worth at a particular point in a time. Consider the decline in its value, its useful life. The current value of assets after accounting for depreciation, that is also called a net present value. Depreciated value, original cost / replacement value minus accumulated depreciation. Next is the net present value. Net present value is a way to measure how profitable an investment or a project is. It calculates the present value of future cash inflow and outflow discounted to reflect the time value of money. Net present value helps in determining whether an investment or project will generate a positive return or result a loss. Net present value helps them figure out the investment will make money or lose money. So before starting of any project or any investment, the owner will see how this project is profitable or loss to him. So he calculates the net present value. Net present value is calculation is the if project is run 4 years, the 4-year outflow will be there. If 6 to 10 year cash inflow is there, then he will calculate cash inflow in to the terms at net present value, and he will minus inflow minus outflow. If inflow is a positive, then net present value will be positive, and if a positive, he can decide to run the project. This is the formula to calculate it. 1 upon 1 plus r power of n minus initial investment. We will study net present value detail in formula and do case study also in income approach method. In this formula, you are discounting the cash flow from each year to their present value, then subtracting the initial investment to determine whether the project or investment is profitable, positive NPA or negative NPA. If positive NPA, then the owner wants to run the project. Now we will study salvage value. Salvage value is the estimate residual value of asset at the end of its useful life after depreciation. It is the amount the owner can expect to receive by selling the asset as a whole or its components, assuming it can no longer be used for its original purpose but still retain some value. Salvage value is usually higher than the scrap value since it may involve selling the assets for parts and secondary use. In salvage value, property is sold after useful life, and it can, if buyer can use the property for other other purpose. And scrap value, the value of assets at end of its useful life when it is no longer usable except for its material component, such as brick, steel, wood, and other raw material with no regard for its original use and functionality. So in a scrap value, after useful life, materials sold separately. You in property you can sell the bricks, steel, wood, doors, window in separate fashion as a scrap. It is not as a component. In salvage value, you can sell in component. Yeah, complete. You can sell the property. Say one steel truss is there. So many steel truss in godowns and warehouse there. You can remove the steel truss and sell the steel truss to in market, and other buyer can use the steel truss for other purpose. In a scrap, it is not a possible. It is the amount that can be obtained by selling the asset as a scrap metal or parts. Scrap value is typically lower than the salvage value because it basically only on the material and contents. So we will learn also difference between salvage value and scrap value. Sometimes 1 mark MCQ can become what that is salvage value or scrap value. Definition. As already we learned, the estimated value of a building or asset at the end of its useful life when it can still be reused or sold. Scrap value, the value of building or asset when it no longer usable except for its material. Material can sold separately, bricks, steel, etc. Condition of asset, the asset is still usable or part of it can be refurbished for further use. The asset is completely worn out and can only be sold for its raw material value higher than the scrap value. Salvage value is higher than the scrap value. Scrap value is lower than the salvage value. For example, a building sold after 50 years. After refurbished for further, we can say salvage value having some marketable value after its useful life. But that building can be useful to buyer. He can refurbish the building and can use further 5 years, 10 years as per his balanced useful life. A demolished building sold for the value of its metal like bricks, no marketable value except scrap value. This is the difference between salvage value and scrap value. Now we will go personal value. Personal value. The value of the property based on sentimental attachment rather than the market force, leading to higher and lower price than market value due to emotional reasons. That is called a personal value and sometimes called also sentimental value. You have seen Amitabh Bachchan Diwar picture. He buy the property. The property owner was surprised. Why buy the property giving me value more than the market value? Then Amitabh Bachchan told, you does not understand because my mother worked in this house. So due to their sentiments of Amitabh Bachchan, his mother worked there. So that value is called a personal value or sentimental value. Next, speculative value. The value of speculative assigned to a property expecting future gains due to anticipate change such as rise in market value or zoning changes. If any nearby in property, any project is coming, say aerodrome is coming, railway lines nearby is going, new project is coming, so nearby property value is the increase. That is called a speculative value. Special value, a personal value based on practical reasons such as proximity to work or school, not emotion. A buyer may pay more of such convenience. A buyer want convenience school for near the property or his office near the property, so he will ready to pay a special value. That is called a special value. Stigma value, the reduced value of property due to negative perception. If any property someone has done suicide, some murder was done, or property built erected on a graveyard, so that value will be called a stigma value, the reduced value of property due to negative perception, which make the buyer unwilling to purchase it, and so it will give a very less rate at that property. Guideline value is the registrar office. The value set by the registrar office at the start of financial year used to calculate stamp duty during property registration. For property registration, every state having their area wise some minimum rates. As per minimum rate, that is called a guideline value. You cannot sell property minimum of this rate, otherwise he has to do the registered minimum rates. Insurance value, the value of building for insurance purpose, typically covering only the superstructure, excluding land and foundation, because the land is indestructible on foundation, there is very little chance, no damage will be happen. So land and foundation, except total value minus land and foundation value, will come a insurance value. We will learn detail in insurance chapter. Hope value. Hope value refer to potential future increase in the property value based on the expected change in external factors such as government policy, zoning regulation, development prospect. Is represent the owner expectation that the property will become more valuable in the future due to their anticipated change. If government change the FSI rules, at present FSI is a 1.5, government will do the FSI 2. So he can utilize land accordingly. So so his value will be increased. So that is called a hope value. Monopoly value. The value arises when property is located in prime area with no comparable alternative nearby, leading to it being sold at premium price. It reflects the unique and advantageous position of property, resulting in a special or fancy price due to its exclusivity. So monopoly value, if a property owner constructed a building at a good prime location and good position nearby and no property similar to that one property, so he can ask a very good price. That is called a monopoly value. Next is intrinsic value. It is the actual and true value of property. For example, if property is purchased for 75 lakhs, but the agreement is made 50 lakhs to save on stamp duty, then 75 lakhs is intrinsic value and the 50 lakhs is the agreement value. In India, in property market, black money is running. So why they are doing the black money? Because they want to save the stamp duty. To save the stamp duty, India stamp duty vary from 5% to 8 to 9%. So if you are purchasing a property of 100 lakhs, then stamp duty, if 7%, 7 lakh he has to pay. So he will declare the property, he will purchase then 50 lakhs. So he will pay the stamp duty accordingly 4.2 lakhs. So he will save 3 to 4 lakhs that money. So he will do the stamp duty accordingly. But actual value, whatever he purchased, that 100 lakhs or 75 lakh, that is called a intrinsic value. Mortgage value. It is the estimated loan amount that a mortgagee can safely lend to mortgager. Whatever safe amount bank can give to mortgager a loan amount, that is called a mortgage value. Market value is calculated the property, after that 25 to 50% reduce the value, bank will give the loan amount, that is called a mortgage value. Notional value, hypothetical value. It is an imaginary value of property calculated for a special purpose such as taxation. Here property valuer do sell the property imaginary, and buyer will buy the property imaginary, and valuer calculate the value of the building, that is called a notional value. The valuer assume a hypothetical buyer and seller in a hypothetical market to estimate the property hypothetical price, even though the owner has no intention of selling. This value is a legal fiction, not a real market transaction, and may also called a virtual reality value. Potential value. It is the estimated price of property could achieve in the market if its current inferior or underutilized use is replaced with the highest and best use. This valuation considers the full development potential of the property, such as unused FSI or switching to more profitable use like commercial in residential zone, maximizing the property value. Next is accommodation value. It refers to value of land that is not independently buildable due to factors like odd shape, small size, or lack of legal access. I will explain. Such land is typically useful only to the owner of adjoining plots, and price is lower than the market value, depending on their needs and competition among the neighboring plots owner. Accommodation value. Please refer this diagram. There are total 9 plots. A is a plot. This side road, and this side is road. But A having no road to go to this plot, he can take the help from this plot. He having not directly asset from the road. So this plot value will be reduced, and that value is called accommodation value. Definition is that the value of land that is not independently buildable due to factor like odd shape, small size, or lack legal access. Such land is typically useful only the owner of adjoining plot. This land is useful of other adjoining plots only, and the price is lower than the market value. His price will be lower than the market value, depending on the needs and competition among the neighboring plot owner. So any neighborhood plot owner can purchase the plot, but he having no access, so he will give the very less value, because sometimes 60-70% reduced value than the market value. That is called a accommodation value.